Schools consist of teachers, students, and principals. Hospitals consist of doctors, patients, and nurses. Who makes up the stock market? We're about to find out. The stock market consists of five main groups: stock exchange, listed companies, stockbrokers, market makers, and customers, who are your institutional and retail investors. We're going to talk about what they do and what roles they play. A stock exchange is a place where stock buyers are connected with stock sellers. Some well-known stock exchanges are the New York Stock Exchange and the NASDAQ in the US, London Stock Exchange in the UK, and the Stock Exchange of Hong Kong in China. A stock exchange facilitates a transaction. Now that we have a place to buy and sell, we need the products to trade. This is where the companies provide their shares. For companies to be traded publicly, they need to be approved for initial public offering, or IPO. Once a company completes IPO, it becomes listed on a stock exchange. Wall Street bets, people. Let's hear 'em. GameStop is public. Palantir, AMC, BlackBerry, yup, are all listed companies. Is traditional IPO the only way for a company to go public? Well, since I said traditional, you probably already know that it's not the only way. Many of you may have heard of SPACs, Special Purpose Acquisition Company, also known as a blank check company. Private companies look to merge with SPACs to go public. If you want to know more about SPACs, be sure to subscribe so you don't miss that lesson later. So now we have a marketplace in stock exchanges and products and stocks of listed companies. We need agents or middlemen to trade shares, and those are stockbrokers. Stockbrokers are professional traders who buy and sell shares on behalf of clients. Brokerage firms are the common stockbrokers nowadays. They take our orders and fulfill them in the market. They usually make money off of commission. We, as stock traders, need a broker to execute trades, just like we need realtors to buy and sell properties. Market makers are firms who actively quote buyers and sellers, providing bids and asks along with the market size of each security. The market needs market makers to create liquidity. Let me explain. The reason that people like about the market is the fact that they can get in and out of a stock fast. Let's say you have one share of stock that you want to sell. You need someone to buy it from you. Usually, if you submit a market order, it is the market maker's job to buy the stock from you during market hours to make sure there is always liquidity, that the orders are always flowing. So a lot of times when you're buying or selling market, you're actually trading with a market maker. Let's say you want to buy 1,000 shares of BlackBerry, and due to FOMO, you put in a market order. Since everyone loves BlackBerry, no one wants to sell. However, the market makers keep an inventory of BlackBerry and sell you the shares. This is what's beautiful about the market. You can buy or sell a stock without delays. Now, maybe you won't get the best price available, but that's the trade-off for quick turnaround for your market orders. So we need market makers, and they make sure that the market has liquidity. They make sure the orders are processed quickly and efficiently. A quick review. What do market makers do? A. They create liquidity. That means they're always buying and selling going on. B. They eliminate delays. Let's say no investors wants to sell a stock that you want to buy. The market makers keep an inventory of it so you can buy it without delay, so you don't have to wait days or even weeks before someone wants to sell it to you. Oh, and one more thing. The market makers stabilize spreads. In the market of buyers and sellers, the buyers may want to buy a share of BlackBerry for $9. This is the bid, and the sellers may want to sell a share for $12, which is the ask. The spread is the difference between the bid and the ask. So in this case, the spread is $3. For certain stocks, market makers need to come in and narrow the spread because a wide spread is bad for liquidity. The market makers need to make sure there are more effective orders by closing in the spread. So who pays the market makers? They can't be doing all this for charity. You're right. Market makers make money by profiting off the spread for a stock. Before I explain how they do it, you need to know that they take on a lot of risk, such as keeping an inventory of stocks. So to offset this risk, they do a few things to profit. You can understand it this way. Let's say there's buyer A for BlackBerry for $8 a share and seller B for $8.10 a share. And here comes another seller C who puts in a market order for a BlackBerry share. Seller C should get the order filled at $8, but instead, the market makers will buy it for $8 from C and then sell it to another person for, let's say, $8.02. They make 1 or 2 cents or sometimes more off each transaction, and this is how they profit and offset the risk. Some of you traders may have noticed when you see something like this and you place a stop loss near the support or right below the support. A stop loss is when the price goes to the stop price you set, your broker automatically sells the stock for you. So when you place a stop loss near the support, I'm sure a lot of you guys have had this experience where the stock price goes down to your stop loss and goes right back up. I hate to break it to you. That is most likely the market makers taking your shares because they can see your orders, and they can see your orders because your broker give them the order book. Your broker tell them where your stop losses are. So this is another way the market makers make money. They drive the price down to trigger your stop loss and sell those shares to someone else for a higher price. We will get into how to deal with this in later videos so you guys can understand it better. But for now, just be aware of this. Lastly, we have customers. And customers can be split into 2 groups, institutions and retail investors. Institutions are financial organizations that invest money on behalf of clients or their shareholders. They make up a majority of the market. Institutions can be hedge funds, mutual funds, investment banks, pension funds, insurance companies, or any other financial management firms. They are the big boys. They're the ones with a lot of buying power. They are the ones driving a price up or down. And finally, retail investors. Retail investors are someone who trades with their own money. You and I are retail investors. If you're trading your own money, you are a retail investor. We're the small boys. Just a quick recap. The main market participants are the stock exchanges, listed or public companies, stockbrokers, market makers, institution and retail investors.